खजाना एक बड़े डब्लू के नीचे छुपा है. I am sure most of you, if not all, will be recognizing this dialogue from the movie Dhamal. And today video, I am going to talk about exactly that khazana and how to find it just in the Indian stock market context. Except in my version, the khajana or the treasure is above the W and not below it. Because we traders have our own version of everything. Hey traders, welcome to your Nifty Guy, where I simplify trading for you. Today, we are diving into one of my most favorite setups, one that I use almost daily in my trading, one that is the most simplest to trade and spot, and has a good accuracy as well. I have lost count of how many superb trades I have taken on this simple setup. And today, I will be sharing my setup with you all with recent examples to show just how effective it is. If you find this video helpful, don't forget to like the video, subscribe if you haven't already, and put down what you think of this setup in the comments box. So let's get started. I like to call this the W setup. Now, this is nothing but a double bottom, which I have drawn around here in a trading context or technical analysis point of view. This setup can help you catch reversals with high conviction and low risk if you know how to spot it the and time it right. So a double bottom is a classic bullish reversal pattern that forms after a downtrend. It is basically the market saying that I have fallen enough and I might be ready to turn around, right? And the opposite of same is the true, which is the double top, which is market is in an uptrend and it is the market's way of saying, okay, I might have risen enough and I might be planning to go down, right? And this might, I'm using the word might because everything in the world of trading is there's nothing which is 100% sure or certain. Everything is like a chance that you take or a probability wise setup that you use. Now, why do I only call it the W pattern? Because even if you are trading a reversal on the downside, which is the double top, on the put chart, you will be trading a W breakout. We'll be discussing it very, very soon because I am an option buyer and I'm discussing this video entirely from an option buyer's perspective, from a scalping kind of trading. So this is the reason why I call it just the W, because even though on the chart it is an M which is forming or a double top which is forming, but if you are trading this setup as well on your put chart, you will be trading the breakout of a W. So I'll be giving you examples as well. So with time, it will be much more clearer. So in case if it is not, do not fret about it. Just a second. I will be just deleting these. So what exactly is a W or a double bottom or a double top setup, which is there? So what we need is we need so this is basically a trend reversal setup, which is there. So what we need is an existing trend. Say, for example, market is falling down, and then we need market to give us a pullback. So that this is exactly the reason why I never go long on the first pullback. I need for market to give me another pullback, and then the market should go up. This is the entry. Similar is the setup for trading on the downside. Market is going up. Market gives us the first pullback. We never short the markets on first pullback. We wait for markets to go up again, and once market goes down below this, this is our entry point. Now, theoretically wise, this is the most simple concept that I believe you can trade. And I will be showing you live examples. I will be covering, basically, I'll try to cover the most from the start of July till the end of July, all the times that the setup has been forming on the charts. Today itself, the setup formed twice on the chart. So let me quickly take you through the examples first, and then we'll again come back to the theoretical part so that it is much more clearer, right? Now, markets, I'm recording this video on 31st. This is the monthly expiry of Nifty on Thursday, the 31st. I will be uploading it tomorrow on Friday, the 1st of August. But I've recorded it today, so I'll be taking everything from today's point of view. So, markets opened with a gap down, recovered, gave us a pullback, and then formed a double bottom around here. If you can look here closely, markets from the day's high fell down, gave us the first pullback. We don't long at first pullback, gave us this dip, and then went up, right? I hope the pattern is clear and easy to spot, right? And I'll show you the same thing on the option chart. So, like I always tell you guys, I trade in the next month's option. I don't know what is this happening. Yeah, sorry. So I traded this particular trade in the 7th of August, 24,500 call option. And as you can see, markets after this particular fall had formed a base around here, down, up, down. This was the neckline. This is the entry. And you can look at this was a massive trade. Obviously, it is not possible to capture the entire move till around here. When I plan to take a trade like this, what I want to see is what exactly is my stop loss. So stop loss is below the bottom low, the recent bottom low, the second bottom which is formed of the W. I'll show you in the charts as well. And the minimum that I want to target is 1 is to 1.5. Post that, anything is good with trailing. Now, today I took this particular trade and I trailed it out around here. But because it was a strong momentum, I re-entered again around these levels and I continued the trade. That is something which I will be speaking about in which I would already have been spoken in yesterday's video, which I will be uploaded on Thursday. But for sake of understanding, I hope this is clear, as in this was a very, very mega jumbo trade. Look at the kind of uh, small stop loss that this setup is offering compared to the reward that is there. Even if you are not capturing the entire, so this was probably a 1 is to 9 trade, and even if you got out around here like me, this is a probab 1 is to 3 trade. 1 is to 1.5, that is something which is required to achieve good accuracy, not a good accuracy. The accuracy of trade is pretty good enough in itself, but that is something that is required to offset the losses when you take when the trade goes against you, right? So that is the minimum that I target. So once I enter the trade, either it is 1 is to 1.5 bare minimum or the stop loss for me, right? Nothing in between. And after 1 is to 1.5, I will definitely be either booking some of my position or I will be trailing it accordingly based on what the price action is speaking to me. So this was the first trade, and then came the second trade around the top. So this was already a resistance area that was marked on our charts, and if you can clearly see, market formed a double top around here. Now, why do I still call it a W pattern, where when you can clearly see a M over here? Because we are not trading Nifty on Nifty charts, but we are trading Nifty on the put option charts. And if you look at the put option chart. Now, this was a trade which was taken in the second half of the day, and that was the reason why I traded in the current weekly, the monthly expiry of the July 25,000 put. And as you can see, markets were completely falling, 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 pull back. Obviously, we do not go long around here. Wait for market to give us another dip. Once this high is taken out, this is where we enter. Now, this what I have marked on the chart is 1 is to 1.5. So you can see markets did go up very close to it, did not achieve the immediate targets. So we'll wait for the market. So even if even these two candles coming in, you don't need to worry, you don't need to book your profits, you don't need to. So patience and discipline is one of the key aspects of trading. Once you enter a trade, you know what exactly are you looking at, and you need to wait. Markets did give a dip, almost came down back to our cost, but then immediately touched 1 is to 1.5, gave a small dip again, and gave us even bigger targets. Now, were you able to capture them? Not. That is something which will depend a lot on your trading psychology and your trading style. But then this is what I suggest, and this is what I personally follow. 1 is to 1.5 is something which I will mark on my charts as soon as I enter the trade. And I will be either booking some quantities around here or I'll be booking out completely around it, all totally depending on the price action and the momentum which is there in the market. And yes, I have a pretty good trailing ability, so I trail my positions a lot. So this was from today's example. Now, if we go back to couple of days back on 29th, again we can see the markets after forming a high came almost very close to the day's low. So this was the downtrend, which was then, if we are looking at a reversal around here, this is what we can see as a double bottom and break of neckline. We see a good target. Obviously, you will be trailing your position out, and you would be, as per my the system that I use, I this would have been my exit If you also look at it, so around here also, this was a double top which was formed. Markets were going up. So I had quickly marked these patterns that I quickly could spot on the charts because I wanted to record this video today itself. Tomorrow I will not be getting the time, and I'm preparing in advance for tomorrow. So this was the entry on the short side as well. If you can see, uh, a double top formed around here would be a W on a put chart, and you could have entered once this low was taken out. You would have gotten not 1:1 definitely, but it could have uh, given you a cost to cost exit. But this was a good setup around here. Now, now I have marked this particular setup in red compared to green. The reason for that is another point that what I would want to explain or how I look at markets. So if you look closely here, we can see a double top. Markets went up, came down, gave a small pullback, went crashing down, right? This is a valid, very good double top setup, but this is not the right place to identify a double top. This is basically a trend continuation that you could have traded, but right now this pattern is all about trend reversal. Markets were falling, gave a pullback, gave a dip. In case if this would have been like this would have been the trade or as per this particular setup, right? I hope I am able to explain to you guys what is the difference and what do you need to look at. So in case if you're looking at a bullish reversal, what we need is a downtrend, a double bottom, breakout. Simple. The setup is pretty simple. So around here, in case the first pullback had come in, the second dip had also come in case if this would have broken out of here, this would have been a valid double bottom trade or a W trade that we could have taken. But this did not happen, that did not trigger, and but instead it formed a flag and pole pattern. So this was the pole. This was a flag pattern. It broke down below it, and that is something that you trade on a continuation part, right? So I hope I have been able to explain why this is not a double top. So you do not trade this particular setup as a double top because this is a continuation trade. Whereas the setup that I'm talking about is a reversal setup that I'm speaking about. Again, here, if you can see, markets opened with a gap up, tried to fill the gap, formed a bottom around here. This was the clear entry, a good trade on the upside. Now, this is again combined with a setup that I personally use, which is a pivot gap setup that I have, wherein if the market opens with a good gap up or gap down and tries to fill that gap but fails to do it, it goes up out in the opposite direction with much more momentum and intensity, right? As you can see, the markets opened with a gap up, tried to fill the gap, could not fill the gap completely, but reversed. And that is a confluence trading, what I call confluence trading, wherein you are combining a reversal setup with another concept that you have, and that will give you a good reward or much more conviction in your trade. Now, again, this around here was a stop loss trade. So all setups will have a fair amount of stop losses, even though the markets did go up and this was just a liquidity hunt. But markets did come down, form a base, form one bottom, pull back, another, and did eventually break out of it. But this particular candle which was there, it went back below the low of the W and took your stop loss, but then eventually the markets did go up. So this was just a stop loss, this market manipulation, which will be there. You will get hunted out, you will get stopped out. Nothing to worry. Whenever the stop loss is triggered, simply accept it and move on to the next best trade. The market is not going anywhere. Do not be trapped into the system of going sad or then again trying to revenge trade. No, we take those emotions into control. Around here, again, I had also spoken about it for my video on this particular day. So markets did fall down, but again, markets went up like crazy in one single shot, and that is why I did not capture this particular move. Because for me to be able to capture this particular move, as per I always say in my videos that nothing happened as per my setup. For me, as per my setup, if after this move it would have given a small pullback and then continued the upward journey, I would have very happily without a self-doubt, an iota of self-doubt would have entered into this particular trade. But markets just simply went out. And even though markets were going out in front of me, the premiums were increasing right in front of my eyes. I did not enter into this particular trade. It is as simple as that, because for me, the setup is paramount, price action is paramount, and they have to give me the entry as per my setup. The market has to give me the entry as per my setup, and only then will I be taking this particular trade. Then around here, after this particular move, you can see markets went sideways. And if you can see, this was the double top on our option chart. This was the double bottom. Now, the stop loss around here was extremely, extremely small, right above this particular. So I'll just quickly tell you the simple rule that I follow. So, if, for example, this is the double bottom which has formed, I will be placing my stop loss below this leg or below this last swing which is there. Now, this swing can either be this swing can be like this swing can be like this, but my stop loss will always be below this particular swing, right? So around here, we did get the 1 is to 1.5. I had taken this particular trade in the market. You can go back to the video of this day. You will be able to find it out, the explanation around there. But this was a good trade. 1 is to 1.5 had given. And then it got trailed out. A trailing stop loss was hit. Again, around here, markets falling. First pullback, we get the dip that we need. This is the entry, stop loss right around here, more than 1 is to 1.5. Markets have come down, formed a base. You get the blue setup entry, you get your targets. Now, around here again, markets went up, came down in a flash, then gave us this particular pullback. First pullback, we don't create long, we got this dip. Above this, we go long. We get the targets. Around here again, markets did form a double top. W would be forming on the chart of the puts. Again, this was a slow trade, obviously not with a good momentum, and might have given a stop loss or a cost to cost exit. I'll tell you some simple rules of trade management as well once I finish with the examples. Markets fell down, first pullback, dip, second pullback. Now, this is the example wherein the market, the second low went back below the first low. You can see markets came down, moved up, came down, moved up. So this low went back below this. So all these are valid setups. I'll be discussing those setups as well. Just give me some time. So this was the setup around here. You got a good move on the upside. Now, post this particular move, you got a double top as well on the same day, same time period. Immediately after that, markets gave a good move on the downside. Markets opened with a gap down, tried to fill the gap, formed a double top. Along with the pivot gap, markets failed to, the pivot gap explosion theory that I have, markets failed to fill the gap. Below this is the entry. You can look at the kind of move the markets gave on the downside. Now markets came down, formed a pullback base, again W. This is where you already would have gotten the 1 is to 1 or 1 is to 1.5, and then this would have been the trailing exit. Again, on this particular day, a down move. And you can see this is not just a simple W, but a complex W wherein a lot of base has formed. But again, no, the entry was not triggered till around this point and the highs were not taken out. And this was the entry with stop loss right around here. And you can see you got the good move around here. Obviously, you would have been either be gotten out of cost around here in market manipulation or not, but you will have been still. This was a good trade to be taken. No trade around here. On this particular day, again, markets were kind of sideways, but then again, had recovered a lot from the day's low. Double top around here, the low being taken out. Good move on the downside. Now, again, around here, why I have said not the most ideal is because the price action wasn't very, very clear. The markets did fall, gave us the pullback, the dip, and the breakout as well. But why I say this is not the why have I written which is not the most ideal is the reason because as you can see on the candles which are forming, there are a good amount of wicks on both the side. Both the candles have wicks on the upside as well on the downside, meaning kind of showing indecisiveness in the market. But nonetheless, depends on your trading style and whether you would have been a aggressive trader, you would have taken this trade. If you are a defensive trader, you would have avoided for further confirmation. You can see this trade did give it a good move, but after the entry, it was slow and sluggish, and it was a Friday, so definitely no point of the theta decay impacting the trade much. But had it been another day, say for example Wednesday or Thursday, the theta decay would have kind of killed you around here before the actual move actually came in. So that is the reason why I have written not the most ideal trade situation around here. So you need to look at these minute uh, hints that the market is giving you, right? So in case if the market was kind of bullish, you would not have seen this dojis around here, and we could have seen much clearer price action, right? So that's it. And again here, markets moved up, down, up. Again, the double top got confirmed around here. This is where you enter stop loss just above here. 1 is to 1.15, 1 is 1.5 received or captured just around till the end of this particular week. Obviously, you'll not be always be able to capture the complete potential of the move, but this is the 2nd of July. Okay, we have reached almost the start of this month. So markets gave a down move, double bottom formed, entry triggered, good move captured on the upside. So this is it, guys. I had marked the entire July for you from the starting till the end. All the examples, the recent examples that I could find and spot. There might be much more examples or anything else that I might have traded, but then I hope I have given ample number of examples. Now, the beauty of this particular setup is because this is the reversal setup, the SL that you get always is kind of very small, and you can target good enough. RR trades that you see because when you are trading a breakout or breakdowns, the probability is low. Whereas in this particular setup, the probability is high, as you can see the number of examples that we had taken. How many trades that hit our 1 is to 1.5 basic target and how many trades it hit our stop loss. So trading is not just about pattern, it is also about patterns plus context plus timing. So never ignore the context. So there are some mistakes that you can have. So never ignore the context. So where exactly is this double top, double bottom happening? So today this was a pre-marked zone of resistance on my chart. So in case if this is happening at a resistance zone, I know that okay, the probability of this is happening. The context, the where exactly is this thing happening is very, very important for us, right? So never ignore the context of where the pattern is forming in case if a double bottom is happening near a support area. Very good. It will be uh, functioning very beautifully for you. In case if the same is happening middle of the price action, there's no support, there's no resistance. The chance of it, it might still work, but the chance of it failing will be higher. It will be a low probable trade. Whereas any of this setup forming around your predefined levels of uh, support or resistance or definite key areas like previous day high, previous day low, previous day closing. These are good areas to look for this particular setup. And another mistake, do not enter the trade until and unless the neckline is broken. We need to wait for the neckline to be taken out, the high of the neckline. So if this is the W, we need this neckline to be taken out, right? We are not entering until unless this neckline is taken out because if we are doing that, that is just guessing that the market will be going up. That's not trading, and that is something which I don't do. So the W or my setup that I just explained is not a holy grail, but when used right, can give you high probability reversal trades with minimal risk. Always combine it with the market context. Where is it happening? And always have a clear SL. In my case, as I told you, I always place it below the recent swing or the second bottom of the W, right? And risk management is key. So in case sometimes what will happen is this W will be a big one. Now around here you can see the prices moved and formed a W in a smaller portion. So your stop loss is small. Whereas around here in this particular trade, the stop loss is big if you compare the number of points. So you can also take your position sizing into consideration based on the number of points, right? So number of points as an SL, always take all trades as though they are going to hit your SL, and number of the quantity that you are taking into the number of points of your SL is the max loss that you are willing to take on that particular trade. And if that loss figure is comfortable with you, go ahead with your regular quantity. If not, reduce the quantity. In case of bigger SLs, it is always advised to reduce the quantity and go in with lower quantities so that you, even if the trade goes south, it goes against you, you are still protected and you are only taking a hit that you can take and sustain and come back stronger the next day, right? So this is a psychological point of view or the risk management part of it. Uh, and if you're looking for consistency, mastering just 2 to 3 high quality setups like this is way better than chasing everything. Another key thing that I have, this is just my personal observation. I'll quickly be sharing it with you. So when a double bottom happens or forms in the market, there are multiple ways in which it can happen, right? The second bottom or the dip that we look at might be above this particular swing. The second dip can be equal to this particular swing, or the second dip can go down below this particular swing and come up. Now, there are versions of people who would say that this is a much better setup to trade because the markets have never breached this low showing strength. Some people say that this particular setup is much better because out here the market has actually taken liquidity from people who have their stop losses placed around here. So before actually continuing the long move, market takes out the liquidity from the market from people who would have longed the markets around here and then gives that move. So it gives that extra fuel to the market to move much above higher. This is the same thing, equal bottom again, kind of liquidity hunting concept. But then, in my opinion, everything is the same. It does not matter, or there is no data to prove which is much more high accuracy and which trade has a guarantee of performing, right? Which setup or which particular formation has the highest guarantee of performing the trade going in your favor. Absolutely, there is. I have found no truth to it. I have found all setups to be equally good. And in case if they fail, all of them can fail. Even if the market has taken liquidity, it can kind of fail. It cannot, even after reaching the stop, it can, if it's a sideways price action, it will not maybe give you target, go down again. Around here, people who say that they are seeing some kind of a strength, but then again, the markets can go up and again reverse. So that is the first rule of trading, which I always say. In trading, anything can happen anytime, and that is something that you need to take care of while trading. So your stop loss and your risk management, your position sizing is something that is always going to be in your hand, and that is something which will define your success in the long term, right? So if you learned something new today, drop me a couple of words in the comment box about how did you find this setup and what do you think of it. Do not forget to like the video, subscribe, and share this with your fellow traders. And as always, trade simple, trade smart. Do not unnecessarily overcomplicate your trading by putting in everything. Trust me, price action is very simple and it will be helping you going a long, long way. Patience in entry and discipline in exit. That's how you win this game in the long term. This is your Nifty guy signing off from this video for today. Thanks for tuning in and cheers.